So we're going to look at some merchandising transactions that would be recorded by a merchandiser who was using the perpetual method. So under the perpetual method, we are constantly updating the merchandise inventory account. We can go to the balance in the general ledger for merchandise inventory and see how much merchandise inventory we have. So the first transaction, we purchase merchandise inventory on account. So we're getting the merchandise inventory. It's an asset account. It goes up with the debit. We debit merchandise inventory. Since we bought it on credit, we credit accounts payable. Then let's say we decide to return some of the merchandise to our vendor. Okay. And so if we bought the merchandise on account, that means our accounts payable is going to go down. Accounts payable is a liability with a credit balance, so it goes down with the debit. It goes down with the debit. So the document that shows that we are making a return is called a debit memo. Okay, that we are returning merchandise and we will be debiting the accounts payable. So if there's a debit memo saying we returned $20 of merchandise, we debit accounts payable for the 20, and then merchandise inventory is going to get credited for 20 because our merchandise inventory is going to go down because we're sending some of that merchandise back to our vendor. Next thing we want to look at are transportation costs. Okay, so we have to deal with these. So the terms of the sale are going to tell us when ownership of the merchandise passes from the seller to the buyer. And whoever owns the goods when they're in transit is the one that's going to pay the transportation costs. So this is important because sometimes we're the buyer of the merchandise when we're buying the merchandise from the manufacturer, the distributor. And then sometimes we're the seller, right? Because then we're going to sell the merchandise on to our customer. So it's important to look at when the buyer pays for the transportation charges and when the seller pays the transportation charges. And so the terms of the sale can either be stated as FOB shipping point or FOB destination. So FOB stands for free on board, but the important part is shipping point and destination. That's telling us when the sale of merchandise is final, when ownership changes hands. So if it's FOB shipping point, the sale is final as soon as the goods are placed at the shipping point. As soon as the goods are brought to the transportation company, the sale is final, and now the buyer owns the goods. So if the buyer owns the goods on the truck, then the buyer has to pay the shipping charges. FOB destination says the sale is not final until the goods reach their destination. So not until they reach the buyer's location. And so a lot of times it's not stated as FOB shipping point or FOB destination. It'll be stated as FOB, the name of the city. So if we had a company here in Chicago Heights and we were making a sale to Louisville, Kentucky, if it said FOB Chicago Heights, that means the sale was final when we bought the goods to the shipping company, since we're here in Chicago Heights. If it said FOB destination, where the seller making the sale, that means, and it was FOB Louisville, that means the sale wouldn't be final until the goods got to the buyer in Louisville. So that's important to look at. So FOB shipping point, the sale is final as soon as the seller gets the goods to the transportation company. So that means the buyer owns the goods while they're on the truck. That means the buyer has to pay the freight costs. Under the perpetual method, these freight costs are going to be part of the merchandise inventory account because it's going to be part of the merchandise, part of what we had to pay to get the merchandise inventory, so we record it as merchandise inventory. So for example, we paid freight charges of $50 on merchandise we bought with the terms FOB shipping point. We would debit merchandise inventory for $50 and credit cash. So we're going to see the cost of the inventory that we purchased. The purchase is going to be the amount we paid to buy the inventory. We'll subtract anything we returned. That's called our net purchases. And then we add in the cost of the freight charges we had to pay as the buyer. That's going to be the net cost of purchases that we're using. If the terms are FOB destination, that means the ownership doesn't pass from the seller to the buyer until the goods get to the buyer. So that means the seller owns the goods while they're on the truck, so the seller has to pay the freight costs when it's FOB destination. So let's say we're the seller, we paid freight charges of $50 and merchandise we sold with the terms FOB destination. This will be a delivery expense. Debit delivery expense, credit cash. Okay. Now, it could be FOB shipping point, meaning the buyer is responsible for paying the shipping charges. However, the transportation company is not going to take the goods unless they have the money up front. So the seller is going to prepay the freight costs and add it to the customer's invoice. And so you probably see this a lot when you're buying things online, that the shipping charges just get added to your purchase. So here's an example. We are purchasing merchandise from Joy Inc. on account. It's $8,400. The terms are FOB shipping point. So we're responsible for the shipping charges, but Joy Inc. paid the transportation company the shipping charges of $200 and added that to the invoice. So when we make the purchase, we debit merchandise inventory and we credit accounts payable for the full $8,600. That $200 becomes part of the cost of the merchandise inventory. All right. Next, we want to take a look at sales transactions. So let's say we made cash sales of $100. So debit cash for $100, credit sales revenue for $100. Well, we're under the perpetual method, so we constantly want to be updating merchandise inventory. So the cost of the merchandise we sold is $60. We bought the merchandise for $60. We sold it for $100. Well, we record the transaction with the customer, the debit to cash, the credit to sales revenue. Now we have to also make a second journal entry to update our merchandise inventory. So we'll debit cost of goods sold $60. We'll credit merchandise inventory $60. Let's say we made that sale on account for $100. The cost of the merchandise was $60. Well, if that's the case, our debit is to accounts receivable for $100 and credit sales revenue for $100. Then we have to update the merchandise inventory in a second journal entry. We debit cost of goods sold and we credit merchandise inventory. So those are the transactions that we're going to be looking at. We're not going to be looking at sales returns. We're also not going to be working with the discounts, just to kind of keep some things simple. And discounts are not as commonly used as they used to be, so that's why I feel okay not spending time on that. We have a lot of other things we can spend time on. But one thing I do want to ask you while we're still talking about the perpetual method is, since we're using the perpetual method and we're always updating merchandise inventory, right? When we buy merchandise inventory, we debit it, right? When we return it, we credit merchandise inventory. When we sell merchandise inventory, we credit it. So we're always keeping a balance in merchandise inventory. So, right, we could go, if we want to know how much merchandise inventory we have, we can just go to the general ledger account for merchandise inventory and look at what the balance is. So do we ever need to count up our inventory if we're using the perpetual method? In class, some people say, well, no, why would we? Others say, yes, we do need to count it up, and they are right because of inventory shrinkage, right? We have customer shoplifting, we have employee theft, and we could be making mistakes recording our inventory as well as counting our inventory. So at the end of the period, we will count up our inventory and we will compare the balance of the merchandise inventory account to the physical inventory amount that we got when we counted it up. And the balance in our merchandise inventory account in our general ledger is probably going to be higher because of things like shopping, theft, spoilage of inventory, depending on what type of inventory you have. And so this difference is going to be called inventory shrinkage. So we're going to make an entry at the end of the period To record the inventory shrinkage, that's going to be part of our cost of goods sold. We'll debit cost of goods sold. We'll credit merchandise inventory, and when we credit merchandise inventory, that should bring the balance in merchandise inventory to the actual amount you have, which you calculated when you counted it up. So here's an example. General ledger shows merchandise inventory has a balance of 11,300. However, when we take our physical inventory and count it up, we find that we only have 10,200 of merchandise inventory. So the difference between the 11,300 and the 10,200 is the inventory shrinkage of 1,100. We will make a journal entry to debit cost of goods sold 1,100 and credit merchandise inventory 1,100. So that's how the perpetual inventory system works.